Welcome, I'm Mark Todd from the NAB, and I'm joined by Richard Murphy from the Australian Corporate Bond Company to talk about the new innovation in bringing ASX listed bonds, exchange traded bond units, to the ASX. They are basically securities which trade on the ASX and offer investors exposure to individual corporate bonds issued by household names like BHP, Telstra and Woolies. And I'm going to talk to Richard about how XTBs work and the benefits and risks and the role of corporate bonds in a portfolio. So Richard, welcome.
Thanks, Mark.
Thanks for taking the time to come on.
Pleasure.
Tell me a bit about the company. What is the Australian Corporate Bond Company? What do you do?
Well, we are the securities manager for the XTB range. So we brought this product to market.
Yep.
So it's our concept, if you like. Their bonds are held in a trust, so there's a responsible entity. We're the manager. We've come from backgrounds that are very diverse, so half the board are fixed income through and through, and wholesale bank guys essentially for 20, 30 years. My background is the exchange, so I'm distribution, exchange, packaging and structuring, etc.
Right.
And so that's really been the genesis of the business.
For the viewers that are watching this, Richard, why the need for a corporate bond market? I'm familiar with the fact that we have a great desire to get some stability in portfolios, but can you talk to the viewers about why you think there's a need for corporate bonds?
I think particularly since GFC, it should have applied before the GFC of course, but asset class diversification. You can't have a portfolio that's just invested in equity or just equity and property. There ought to have been, and now there is, asset class diversification.
And the other point about senior bonds is they're less volatile. Equities are much more volatile. So for retirees,
Yes.
It's all about income. And I feel that a lot of the
Yeah.
times that the retirees just don't like the fact that there's so much volatility in equity markets, particularly at these sorts of levels where we're reaching record highs all the time. There must be that sense of nervousness. How do you think this product, the XTBs, will help in the question of volatility?
We had a look actually recently at a chart looking at the All Ordinaries accumulation, or the ASX 200 accumulation index, which looks at the ASX 200 plus dividends over the period 92 to current times. And then we looked at a corporate bond index over the same period. Your point, volatility. The volatility on an annualized basis for the accumulation index was 14.7%, as you'd expect. Equities are volatile. And the corporate bond index was 2.7%. The returns, annualized returns on the equity were, as you'd expect, higher at 9.7. For the corporate bond index, it was 7.7.
So you're not really giving it much?
You're not giving up much for a much more stable asset class, and that's why when I look personally at my savings at that chart, I thought, wouldn't I like to have been diversified? Being diversified would have been a better place to be than just be long equities. So it's not saying equities are bad and bonds are good, it's saying they're both good, but a diversified portfolio is where you want to be.
Helps you sleep better.
Exactly.
That's the idea. I completely agree. I think NAB's had a strong view that the bond market should be able to be, part of the retail portfolios. What sort of bonds? You've mentioned a few. Give me another half a dozen of different bonds that you might have.
Well, they're all senior bonds, so we're not looking at subordinated or down to hybrids. So they're all senior unsecured bonds. The top 50 companies is where we've started out. So we limited ourselves, and ASIC was happy for us to limit ourselves to the top 50. So none of the bonds are from corporates outside the top 50 at the moment. So there's 17 in total. We'll bring out another 15 in a couple of months' time.
And how does it work for the viewers? You've mentioned that you're the responsible entity, and the bonds will be XTB. What's the code that people will look for? But how does it physically work?
Yeah, the XTBs, exchange traded bond units. There's a trust that will hold the bonds. Mm-hmm. A managed investment scheme that has an RE. We're not the RE, there's a separate RE from us, we're the manager.
For the viewers that are watching this, an RE is a responsible entity.
Yep. So every managed investment scheme, every
Yep.
property trust, every ETF has got a responsible entity.
Yep.
And then there's a manager who actually runs the product, if you like. They're the commercial side of the business. And the responsible entity is the regulatory side of the business. So the trust owns the bonds. There are bond units issued, the XTBs, that are listed on the exchange on a one-for-one basis with the underlying bonds. So the 17 underlying bonds are held separately, 17 separate securities on the ASX.
Okay. And none of this is ever for free, so let's talk about the fees associated with this. I think it's always an awkward
Yep.
conversation, but let's get into it.
So essentially what we do, so a bond is trading at a yield in the wholesale market. Let's say that was 3.9% for a Lend-Lease bond. we add 40 basis points onto that, so the yield of the XTB on the ASX 3.9 would drop to 3.5, so about 40 basis points for every year.
And that pays for establishment, setting it all up, doing the trust work, the responsibility.
Yeah.
There's a lot of
regulatory capital, sales and marketing, employees, etc. So everything comes out of that. So it's a one-off fee that's paid at the beginning.
Yep.
And so coupons and principal we don't touch, and that's really the idea. We don't want to touch coupons and principal.
That's great. Look, Richard, all the best with this initiative. It sounds like it's a great idea. I think getting the bond market to the retail market is fantastic. I think it's a great idea. So I wish you all the best with XTB, and we'll talk to you soon.
Thanks, Mark.